So our group is to tackle about chapter 6, which is the analysis of risk and return. So what is all about within this chapter? So this chapter develops the relationship between risk and return in more detail, presents methods from measuring risk. So this chapter focus on investment and investor diversification and portfolio risk analysis. Okay, so we define first the meaning of the measurement of the risk. So first is risk. So risk is the possibility that actual future returns will deviate from expected return. So from the perspective of security analysis or the analysis of investment in some project, risk is the possibility that actual cash flow will be different from the forecasted cash flow or returns. So the investment is said to be risk-free if the dollar returns from initial investment are known with certainty. So some examples is the risk-free investment are the US Treasury securities. Okay, so another one is the probability of distribution. So it indicates the percentage chance of occurrence of each of the possible outcomes. So the probability may be determined either objective or subjectively. In objectively, determination is based on past occurrence of similar outcomes, whereas subjective one is merely an opinion made by individual about the likelihood that a given outcome will occur. So next one is expected value. It is the statistical measure of the mean or average value of the possible outcomes. So operationally, expected value is defined as the weight average of possible outcomes with the weight being the probabilities occurrence. Okay, so before we proceed for the formula or how we compute all the risk and return in this chapter, so this summary of notation, this can help to examine the specific measure of risk and return which summarize the basic elements of notation throughout this chapter. Next is standard deviation. So standard deviation is the statistical measure of dispersion of possible outcomes about the expected value. So it is defined as the square root of weighted average square deviation of possible outcomes from expected value as computed as follows. So it is presented on slide 8, which is the how to get the standard deviation. Okay, so this table represents the probability distribution of return from Duke NTI company. So the state of the company is in recession, normal year, and boom. Okay, so the rate of the return is anticipated under each state of the economy. So in recession, there is 10% in Duke and negative 4%, which is the probability is 0.2. In the normal year, they have 0.6 in boom 0.2, which is equivalent to 1. So this would be the probability distribution. Okay, so for this table, this is table 6.3, which is expected return of calculation of investment of Duke NTI company. Okay, in this table, has three state of economy, which is recession, normal, and boom year. So as given of 6.2, the probability distribution for the company, which we should use in this on how to calculate the expected return. So the probability for Duke in normal, boom, and recession is 0.2, 0.6, and 0.2. Okay, so in Duke company as given in 6.2, so we just multiply the probability and the rate of return. So 10% multiplied by 2 is 2%, as well as the normal boom 10.8 and 5.2. So we just add up this three state of economy. So the expected return is 18.0. So this will goes as 40i, which is 18%. Also, this is the expected return calculation of investment of Duke NTI company. Okay, let's continue. For this table, 6.4. So, this computation of standard deviation of return of Duke and TI. So, I've discussed earlier what is standard deviation. Okay, so for this formula, where O is the standard deviation. So, standard deviation can be used to measure the variability of returns of an investment. So, a such given indication of the risk involved the asset of security. So, the larger the standard deviation, the more variable are investment returns and the riskier is the investment. So, standard deviation of 0 indicates no variability and those no risk. Okay, table 6.4 shows the calculation on how to compute the standard deviation return of the Duke and TI company. So TI, as you can, the Duke has 5.6% return and TI has 13.91%. So TI appears riskier than Duke because the possible return from TI are more variable measured by standard deviation, which is 13.91% than those of Duke, which have the standard deviation only 5.0%. So this example deal the discrete probability distribution outcome. So for each firm, it is limited number of possible outcomes and identified probabilities. Okay, so next one is the normal probability distribution. So it is characterized by a symmetrical bell-like curve. So in 6.1, this is the continuously probability distribution, expected return from investment, and Duke. So it is, as you can see, it is a curve-like. It is the normal probability distribution for the two stocks. So this is the rate of return. So in Duke, to 10% is a 10% to up to 18%, then go down to 21%. So it has curve. So under this figure 6.2, so for example, it is apparent that the actual outcome should be between plus or minus. So the standard deviation from the expected value is 68.26% of the time between the plus and the minus. And then the standard deviation is 95.44% of time, and between plus or minus is the standard deviation is 99.74% of the time. So this, which is illustrated in this table. So the number of the standard deviation, z is the particular value of r is from the expected value, is computed as follows. Okay, so in this, how do you determine the probability of earning negative rate of return? Okay, so we have the example of TI stock. So supposedly, we are interested in determining if the probability earning of negative rate of return. So the return is less than 0%. So the probability is represented graphically in 6.1, which has has a TI probability distribution. So the number of standard deviation that 0% is from expected return rate from 18%. So in substituting, so 0% minus 18% over 13.91% is equivalent to negative 1.21. So in other words, the return of 0% is negative 1.29 standard deviation below the mean. From the probability associated with 1.29 standard deviation is 0.985. So therefore, there is a 9.85% chance that TI will return below 0%. So conversely, there is a 90.15% chance that the return will be greater than 0%. Okay, so next is the relationship between the risk and return. So in this, the trade-off between the risk and return is the key elements of effective financial decision making. With this, the required rate of return is equivalent to risk-free rate of return and risk premium. So what is the risk-free rate of return? So refers to the return available in the security with no risk of default. So risk-free rate, it is the rate investors of financial asset is determined the financial marketplace and depends on the supply of funds available as well as the demand for these funds. So first, risk premium is a potential reward that investor expect to receive when making a risky investments. And required rate, it is the is expected to be generated from the company investment. Okay, for example, the inflation is expected to average 4% over some future period. The risk-free rate of return on US Treasury bills. So, assuming the real estate return of 3%, so is equal to 4% plus 3%, so 7% is the required rate of return. Okay, to continue the relationship between risks, so risk premium is assigned by the investors to given security in determining the required rate of return. So there are four elements: maturity, default, seniority, and marketability of risk premium. So let's first discuss the maturity. It is the return required on the security influenced by the maturity of the security. So the term structure of interest rate is the pattern of the interest rate yields for the securities that differ only the length of time of the maturity. So next is the default risk premium. So it is effectively the difference between a debt instrument interest rate and the risk-free rate. So the default risk premium exists to compensate investors for entities' likelihood of defaulting of their debt. So security risk premium. So these securities differ with respect to their claim in the cash flow generated by the company, a partial listing of the securities from the list to senior. And lastly is the marketability risk premium. Marketability is the ability of the investor to buy and sell company security quickly without a significant loss of value. So it refers to the extra interest rate charge on loans to companies whose stock may not easy to sell.
Okay, so business and financial risk. So in business, financial risk, it is the variability in the firm's operating over time, while financial risk, refers to the additional variability in companies' earnings per share that results from the use of fixed cost source of funds such as debt and stocks. So business and financial risk are reflected in the default risk premium applied by the investors to firm securities. So the higher the risk, or the higher the premium and the required return on the firm securities. So this table is the relationship between the default risk required in return. So it is the represented by the various risk premium just discussed above, and all the securities have more elements of additional risk resulting to the increase required of return. So in this, the relationship between the risk and return can be observed in the examining of returns actual earned by the investors in a various types of securities over the long period of time. Okay, lastly is the investment diversification and portfolio risk analysis. So in this, asset is a collection of two or more assets. The portfolio risk, the risk associated with collection of financial and physical asset is considered in the following two sections. So what can be the return and expected to be earned from the portfolio? So what is the rest of the portfolio? So in this figure, it shows the variation of the rates of return in the aluminum industry over the time panel. So letter B, it shows the corresponding variation of returns from gold mining over the time frame, and panel C shows the combined rate of the minimum operation, and the return from mining tends to be low and vice versa. So the combined returns of more stable, therefore it is less risky. So investment diversification and portfolio risk analysis has a correlation in which between any two variables such as rate and return or net cash flows is relative statistical measure of the degree to which these variables tend to move together. So in this illustration, the perfect positive correlation is the perfect negative correlation and zero correlation for different pairs of common stocks and investments. So for the perfect positive correlation from panel A, high rates of return from stock L are always associated with the high rates of return. So from stock M, conversely, low rates from return from L are always associated with low rates of return from M. So in this, no perceptible pattern or relationship exists between the rest of return of stock V and W.
So